Hello, hello. Thank you for joining me on this week's podcast and the fourth podcast in my 4 week series, the fourth and final podcast in my 4 week series on making the kind of money you want to make in your business. So, this week I'm going to be talking about paying yourself what you want to pay yourself, right? Because that's really the ultimate goal. So, if you've been following along in this series, I've been talking about making the kind of money you want to make in your business from the standpoint of all the things that often keep entrepreneurs from making the kind of money they want to make in their businesses. And before I go on, I'll introduce myself. My name is Leslie Taylor. I am the profitability strategist, and my firm and I, we help entrepreneurs manage their numbers into profitability. Now, ultimately, for pretty much every single business owner, that's really the goal. Being able to pay yourself what you want to pay yourself. Yes, perhaps you have a passion for what you do, the ins and outs, the technical parts of what you do, or maybe you just love building businesses like I do. Yes, maybe you've been called to serve, right, in a certain way, and you are fulfilling that service in what you do and what you do for your clients and customers. But ultimately, you started this business because of what it can do for you, because of what it can do for your family. It comes down to being able to make the kind of money that you want to make so you can live the life you want to live. And that may be a very modest life, but ultimately we have to live somewhere. We need shelter, we need food. There's things we want to do, places we want to go and travel and be able to do all of that. Of course, it takes money. And so if we drill down past, revenue goals for our business and six-figure sales and seven-figure businesses and this, that, it really comes down to how much we're able to pay ourselves and whether we're able to pay ourselves. And so this week I will be talking about paying yourself what you want to pay yourself, because quite honestly, I get a lot of questions about this area. And if I can share a little secret, I get a lot of entrepreneurs, I see a lot of entrepreneurs who aren't either paying themselves at all, or they're paying themselves very little. And so, they're not where they want to be. They're not where they want to be, especially in terms of paying themselves. And so that's a big issue, especially when that's one of the ultimate goals. I mean, there's fulfillment, there's other things, but that's a big issue. It's a big problem. Now, last week, I talked about first coming up with an actual number, an actual target number for how much you want to be able to pay yourself. And if you missed last week's, I highly recommend you go back and listen to it. But in a nutshell, if your answer is something vague like six figures, or something random like half a million or a million, I suggest you actually calculate what I call a right now salary. And that's how much it would take for you to live comfortably right now. It's very simple. Given your debt, given your expenses, given your situation at this moment in time, your obligations, you know what they are. So assuming you have an actual number with digits, let's move forward. So first off, let's talk about how you will pay yourself. How you will pay yourself. We get a lot of questions on this. There are two basic ways to pay yourself as an entrepreneur. Method one is through what are called distributions. And method two is by paying yourself an actual salary, or what is called a salary. Now, I'm going to go into more detail with both of these, but let's talk about how you figure out which method is correct for you. The method you are required to use will depend in part on how your business is set up. And this is determined by your business entity. It's determined in part by your business entity. And by entity, I mean, are you a sole proprietor? Is your business an LLC, a partnership, an S corporation, or a C corporation? How you are allowed to pay yourself will be based on a combination of your business entity type and how the business has elected or is required to pay taxes. Yes, I said required. And so, this is why, as a side note, I always suggest having the advice of both a legal professional and a tax professional when forming your business, because there are a lot of downstream implications to your decision. Your decision is going to affect a lot of things. So, yes, you could do it yourself, you could DIY it, but most business owners aren't really prepared or versed to make a decision based on what's best for their stage of business, their planned earnings, their overall tax situation, and with how to minimize the risk to their personal assets and or the assets of other businesses they might have. Most of us are not able to do that. At least I'm not. I don't know about you, but I'm not. So, so let's dive into these two methods. So the first method I want to talk about actually is salary. Paying yourself a salary means paying yourself as a W-2 employee of the business. So in this instance, federal income taxes, state and local taxes, Social Security, Medicare, they're all withdrawn from the salary. Federal and state unemployment taxes are also paid. Now, these amounts are calculated and money is withdrawn every pay period. Then, when appropriate, they're paid to the right folks, the right entities, right? That money goes to state, feds, whoever. Now, paying the correct amount of these taxes is the responsibility of the employer. So that would be you if you're the business owner. A salary is actually legally required for businesses that are structured as S corps, S corporations, C corporations, and some limited liability companies that have elected to be taxed as corporations. So, see what I was talking about before? It not only depends on your business entity type, but also how you've chosen to be taxed. How you've chosen for the business to be taxed, rather. So furthermore, the IRS has a requirement that the salaries be reasonable, and there's a whole definition for that, which I'm not going to delve into. It's outside the scope of what I'll be talking about in this podcast. But if you really want to know, of course, you can always talk to your tax professional or send an email to info@ltaylorassociates.com. That's info@ltaylorassociates.com. And you'll find that information, I think, as well, a link at the bottom of where you're listening to this podcast. But I did want to mention that the IRS, that they do dictate which types of business entities and structures have to pay themselves this way, and that they dictate how much those entities or how much the business owners need to pay themselves in terms of a salary. So that means you're running payroll, or hopefully somebody's running it for you, whether it's an ADP or a Gusto or a Patriot. And that means they're doing it on your behalf, right? They're paying those monies, they're pulling the money out, where it needs to be pulled, and they're paying it to the appropriate folks. So that is salary, and that's what it looks like to pay yourself a salary. Now, another way, as I mentioned, to pay yourself, method number 2, was through owner's distributions or owner's draws. I didn't say drawers, I said draws. This could also be members distributions, partners distributions. You can plug and play those titles, but the key word is a distribution or a draw. Now, this method of paying yourself as an owner is a lot less structured, meaning you can take these distributions, you can withdraw whenever you want to, technically. However, I do recommend that business owners pay themselves regularly on a set schedule. It makes the business look more professional, and it helps you to keep track of the money that you're taking out of the business. So I suggest a more regular dollar amount, a more regular pay interval, as opposed to random. And I'm going to talk a little bit more and give you a story on that in just a little bit. Now, the big difference here, obviously, is the amount of freedom you have in terms of how much you can take and when you can take versus a salary. It's just not as structured. The other big difference, of course, is when you're paying yourself in this method, you're not paying taxes with every distribution or with every draw, like in the case of a salary. So, does this mean that you don't have to pay taxes? Of course not. Of course not. You still will have to pay taxes. And this is where many businesses might need to pay what are called estimated quarterly taxes. So again, this is another good time to talk to your tax professional. And they're going to be asking you questions related to your earnings, related to your business financials. So you'll need to have some answers. So you'll need to be very organized. Your records will need to be organized. In general, you're going to be taking an owner's draw or an owner's distribution if you are a sole proprietor or an LLC or a partnership. Again, of course, talk to your tax professional, talk to your financial professionals about which options are going to be best for you, are well suited for you and how you're structured. And as I'd mentioned earlier, and as you could see, the LLC has some different options, right? An LLC could be required to pay themselves as a distribution or a draw, but they also, depending on how they elect to pay their taxes, may need to pay themselves a salary if they're chosen to be taxed as a corporation. One thing to note, even those businesses that are required, where the owners are required to pay themselves a salary, they can also take a distribution. They can also take distributions out of the business. So they can take a salary and a distribution. However, businesses that can only take distributions, they can't pay themselves, they legally cannot pay themselves a salary as a W-2 employee. They are not allowed. They are not allowed. And here I want to take the opportunity to re-emphasize that business structure is really important in determining not only how you pay yourself, but also in minimizing your tax liability. So that's why I always say, and I'll say it like, I'm saying it again, it's really important to have good counsel when you are deciding your business entity and when you are deciding how you want to pay your taxes as a business. So let's move on to two questions that I often get from entrepreneurs regarding paying themselves. And the one question is, when can I pay myself? The other question is, how much should I pay myself? First, as I mentioned earlier, if you are required to pay yourself a salary, there are some guidelines as far as minimum amounts or minimal amounts that you need to pay yourself. Now, with that said, sometimes paying yourself can be a challenge because we first want to make sure there's enough cash available to do all the things, right, in our businesses. And if there's not enough cash to do all the things, we can run into a problem. So whether you are in a position to pay yourself right now, or you're getting ready, you're trying to position yourself to be able to do that, or you're considering giving yourself a raise and you want to know what sort of things you need to be thinking about and considering, when you're ready to pull the trigger on that, I want you to ask yourself this question. Am I breaking even? Now you may be asking yourself, well, what does it mean to break even, Leslie? What does that even mean? To break even means that you're able to consistently cover all of your expenses and costs. That is what is in the financial world, in the accounting world, called the break-even point. So every single month, you're able to cover all of your expenses and costs. Now, keep in mind, breaking even isn't the ultimate goal because it means you don't have anything left over. So I first want you to answer the question, are you at least breaking even? Are you at least breaking even every single month? Because then we can have a conversation. Are you consistently able to pay your bills, meet your obligations in the business? If the answer to the question is no, let's explore that because there can be several reasons why, and we need to get to the bottom of them before we can even discuss you being able to pay yourself, obviously, because there's not enough money. So we need to figure out why there isn't enough money and address it. So is it a revenue issue? Right? And remember, revenue depends on not only the price of your product or your service, but also the volume or how much you actually sell. So is it a price issue? Is it a volume issue? Right? Those are both under revenue. I mean, maybe you do need to find more clients, but maybe you just need to change your prices. Or maybe your prices are fine and you just need to find more clients. A revenue issue. Is it an expense issue? Ask yourself these questions. Are you spending more in certain categories than you really thought you were? Takes some insight into where the cash is going to determine that, of course. Are you overspending based on what you budgeted? Are you spending more in certain categories than is reasonable or than you think is reasonable? Are your vendors raising their prices? Are any of your main service providers raising their prices? These are all things to consider. Are you spending money on things that you're not using? Whether it be courses, whether it be coaching that you're not implementing. Again, is it an expense issue? Now, as we consider all of this, one other thing that I always like to point out is the consideration of debt and taxes. As we're thinking about this, we don't want to forget and to set money aside to make sure that we are meeting our debt obligations, credit cards, loan payments, as well as making sure that we are paying enough in taxes and or setting aside money for taxes. Again, talk to your tax pro, your financial pro about that. So if the answer to that question is no, you have a little more homework to do. Now, if your answer is yes, and you have a definitive yes, you're breaking even with not just breaking even, but you have cash to spare every month, then you should be able to pay yourself, assuming that you're not commingling and pulling multiple untracked distributions from your business. Yes, this is a huge issue among entrepreneurs. So, side story. As part of my onboarding process, one of the questions that I ask future clients, onboarding clients, is whether or not they're paying themselves. And so on more than one occasion, I've had entrepreneurs tell me, no, I'm not paying myself. And then we get in there, we peel back the layers, we see what's really going on under the hood, and we see several random distributions and draws from the business. And we see several personal expenses being paid by the business. And then when I go back to the business owner, I need to inform them, these are all owners' distributions. You were paying yourself. This was you paying yourself. And in one specific instance with a client, I had the, I would say unfortunate, but it was fortunate because it brought it to light so that he could then make a change and make a different decision, that he had in fact had so many distributions, not paying himself an actual salary though, but not, W-2 salary, and not to what he was believing or aware was a salary. But he had so many distributions that in fact the business ended the year with less cash than it started the year with. So he actually used up all of his profits and then some in that given year. Yeah, it is a thing. It's a huge problem. So assuming that none of those things are happening with you and you've got this extra margin, part of the process involves you, the owner, getting a very clear understanding on how much profit, how much leftover cash you actually have in the business on a regular basis, understanding how much margin you have. And once you've decided how much room you have to cover both your expenses, your salary, any debt obligations. And honestly, I recommend that once you've been in business for a while, that you begin to create budgets that actually include your salary. And you might not, you might want to do it, as early as possible in your business as a goal. So you can kind of keep that in mind, so that you are not, what's the word, getting a false sense of your business's performance, right? So if you leave those numbers out, you're not paying yourself at all. Then you may be thinking, oh, I'm doing better than I am. But then you really start, if you plug that number in, then you can see where you really are, because ultimately a part of your business needs to be you paying yourself. And again, if you've actually, the other thing that I'd mentioned earlier was actually having a number in mind for how much right now you want to be able to pay yourself. And so if you aren't, now you have this reasonable number, and you can bring those things together, right? Can you reach the one goal with what you have left in the business? And that goal being able to pay yourself that number, that right now number that we talked about earlier. Now, in terms of actually exactly how much you should pay yourself, that really is up to you, and up to how well your business is doing. But one method that I really love, that I think makes the most sense in terms of how business owners should pay themselves, is based on a percentage, right? Is based on how well the business is doing each month. So first, I like this method because it directly links, how well the business is doing with your compensation, how well you are leading the business with your compensation. But secondly, I like this method because oftentimes for many businesses, for most businesses, income is variable every single month. It's up, it's down, it's up, it's down. So it becomes really difficult to pay yourself a fixed amount if the business is up and then the business is down. During very down times, that's the challenge. But ultimately, whatever you choose, you want to make sure that you can continually commit to being able to pay yourself that number so you don't run into trouble. So choose wisely based on the questions that I've given you. But also, you're going to need to be tracking things a lot closer so that you can make sure that, hey, now that you're paying yourself this salary, now that you are increasing your salary, that you can continue to do so and not run into any challenges. Now, whether you answered no to the question, saying you had, not broken even yet in your business, or you were struggling to have enough cash in your business, or whether you answered yes to that question, that you had enough margin to be able to pay yourself or to increase your salary, I ask you this question: would you like to have even more cash in your business? Well, duh, Leslie. Maybe you have a nice consistent cash flow, because of all the clients you have, all the customers you have, and you'd like to begin expanding your reach, or stepping out of doing all or less of the things by scaling your business. Or maybe you're struggling to find clients and are stretching your resources to cover your monthly expenses. Whichever the case, what if I told you there were steps you could take to increase the cash in your business without increasing your workload, adding clients, or adding hours to the day? What if I told you you were leaving money on the table? Well, over the next 2 weeks, so starting next week, the week of July 4th, I'm going to be sharing how I help my clients do just that in my new masterclass, The 3 Most Effective Strategies for Increasing Cash in Your Business. Oh, and the best part is, it's free. So in this masterclass, we're going to walk through mastering your revenue, profitably pricing and packaging, how to find money leaks, and we're going to talk about a process for mastering your cash flow. So to sign up for the webinar, click the links below where you're listening to this podcast and register. I can't wait to see you there. Stay profitable.